This is oil just today, folks. This is oil from the beginning of July. All right, so yeah, you want to tell me inflation's not around anymore and it's going back to sub 2%? Okay, let's be real. All right, gasoline, you want to see what gasoline's doing today? We'll go back to Ethereum real quick. I don't mind. That's your gasoline for the month of July. So you're looking at month over month numbers spiking. Okay, this is inflation is going to be stuck at 3%, give or take. Doesn't mean it can't go to 2.9, 2.8, whatever, but I'm going to tell you right now, it's not going sub 2%.
The Bank of Japan made a significant announcement heralding a shift away from decades of massive monetary stimulus. The move allows the country's interest rates to rise more freely in response to increasing inflation and economic growth. This decision is seen as a potential seismic shift for global financial markets. The BOJ made its bond yield control policy more flexible and loosened its defense of a long-term interest rate cap, aligning itself with other major central banks that have taken aggressive measures to combat soaring inflation after years of stimulus-driven growth. The United States is experiencing the impact of rising interest rates on its borrowing costs. During the pandemic, the country was able to borrow at historically low interest rates. However, as the Federal Reserve increases the federal funds rate, short-term rates on Treasury securities are also rising, making some federal borrowing more expensive. Expectations about short-term rates and inflation have already led to an increase in longer-term rates. In the video, Gareth Soloway discusses the U.S. annual interest expense and the GDP curve, highlighting the potential implications of these economic indicators. He also delves into an analysis of cryptocurrencies, focusing on popular digital assets such as Bitcoin, Ethereum, and Matic.
This is, as it says, the U.S. government annual interest expense. All right, look at what has gone on here. Interest expense is nearing $1 trillion a year. All right, that is now greater than the biggest part of the U.S. budget, which was the military expenditures, right? So again, the U.S. spends, I think, $800-something billion, which, by the way, is like more money than the other 5 top countries combined. That includes China and India and lots of other big names out there. So not only is the U.S. spending a ton of money on military, which you could argue is a good thing, but also look at what's going on here. The interest expense. Now, I look at interest. When I'm paying interest on something, it's money that's going in the toilet. It is money that's getting thrown away because, again, it's just getting paid out because you spent too much damn money and now you have to say, okay, well, we have to pay that back or we have to pay the interest on that. And again, the problem is this, folks, is that I've been arguing that while we have an economy that right now is still growing a little bit, GDP is still growing a little bit, I've been saying that there's dark clouds on the horizon. And when you take this much money and you flush it down the toilet, when this money could be going to growing the economy, when it could be going to, let's say, healthcare or Social Security or other things, that to me is horrendous. And every American, every person out there, and by the way, it's not just America. Go to any other country out there and you're going to see a lot of the same stuff. And that is a problem. This is average monthly payments for new cars. Now, again, for those of you that may be in your 40s or 30s, when you first got a car, I remember I had a little Honda, I think it was a Honda Civic. I think I paid $200-300 a month for that lease. Look at what's happened, guys. All right, look at the average monthly cost. And the reason I'm bringing this to your attention, I'm showing you costs that are advancing, costs that are blowing up. And because ultimately this sucks more and more money out of the individual, the consumer, that is going to be harder and harder to kind of keep the economy trudging along, especially when you have interest rates going nuts. So again, you're now talking about the average American, the average person is now getting close to $750 per month on a car payment. All right, on to the next one we go here. Now this is a pretty crazy one, folks. Now we talk about how the economy is offsides. The chart showing net speculative positions in treasuries has collapsed. Now, what's amazing about this is that we have net speculation in treasuries, meaning that people are more interested in being in stocks than pretty much any time else in history. Now, think about what that means. You have U.S. bonds paying more money than they have. Interest rates are as high as they have been in 22 years, meaning that even when interest rates were, 25, 50 basis points, people were more interested in being in bonds than they are now. All right, meaning that people are more interested in investing in stocks right now, even with the bond market paying what it is. That is a huge lopsided issue, folks. And again, think about this. Think about it logically. Like, does it make sense that when you can get 5%, let's say on a treasury, that you would be still more interested than you were when you could make 0.25% on a treasury or half a point on a treasury? You'd still be more interested in investing in stocks? That is a way offside scenario.
According to Decrypt, a crypto-based news outlet, D5 exchange Curve Finance has confirmed that several Ethereum pools were hacked. Additionally, they suspect that an Arbitrum-based liquidity pool might have also been potentially affected over the weekend. The platform was exploited on Sunday, resulting in a loss of over $24 million. However, blockchain security firm PeckShield has updated the stolen amount to $52 million as the hack continues to unfold in real time. As the situation develops, Gareth shares his analysis of the crypto market, offering his speculations, especially concerning Bitcoin, Ethereum, and Matic. Let's now return to the video for further insights.
Right now, we know GDP last week came in higher than expected. And the kicker is this. This is what most people don't know. When real imports, when imports drop, all right, so meaning that when you as a group are importing less, so the American public is importing less from China, from all the other countries, GDP actually naturally will go up because imports are subtracted from what's going on in the US. So, for instance, when you have GDP at 2%, well, let's use a bigger number. Let's say 5% GDP, or it would be 5% GDP, but you're importing 2%, then your actual GDP is 3%. You're subtracting what you're importing. Now, the problem with your GDP numbers is that we have now seen a decline, a massive decline in imports in the US, which is artificially buoying the GDP number to the upside. So again, everyone's so amazed, like, oh my goodness, 2.4% GDP. Well, yeah, but why are we're seeing imports decline precipitously? Now, you might say, oh, this is great. Maybe the US manufacturing side is doing so much better. This is the kicker. Is it that? Or is the economy weakening, and are we importing less because the consumer is weakening? And even if the consumer is weakening, which by the way shows you that a recession is probably 3, 6, 9 months away, even that, a consumer weakening in the short term artificially lifts GDP. So these are things, again, folks, that even I didn't know a few years ago. But as we get into this data and you dive in and you do a deep dive, you start to recognize more and more. I showed you guys this last week when it was early on in the bear flag. This now is a mature bear flag. In addition, you have a time count. Time counts are powerful signals. They're timing factors that repeat over and over. In fact, if you go into the time count that I use is the 7 factor. And you could go through any religious text. You can go through almost anything, 7 days in a week, the 7 deadly sins. You could go. There's things that in human nature repeat over and over again. And they repeat in charts over and over again. So just to give you a sense of this, right? So you could look here, right? Pivot low, 1, 2, 3, 4, 5, 6, 7. All right, here, 1, 2, 3, 4, 5, 6, 7. So the idea is that nothing's written in stone. It doesn't mean it's a guarantee, but what it does mean is that in general, bigger moves or significant periods tend to occur on a 7-point. This is bearish. The idea is you likely are going to have a down move. I think your max downside right now remains at 27,000-ish, give or take. It's an upsloping trend line. Nothing really has changed from last week on that chart. Now, I am keeping an eye on Matic. I think Matic is starting to break lower here. All right, we've broken below this flat line right here. That's problematic for Matic. But again, we're looking at another support probably in the 65-cent range. Ethereum here, folks, bearish consolidation. You've been in a general downtrend. This is your down target, 1750. I would continue to expect 1750. And by the way, doesn't mean we can't go higher. And like I said, with the Fed going back eventually to printing of money with what we see in Japan, eventually we're going to see Bitcoin and Ethereum rocket. All right, eventually these things are going to go. Is the 4-year cycle in stone? I think people that are adamant that, oh, it's a 4-year cycle, they're new investors. That's just the nature of it. You know, when you trade a market for 20 plus years, and I had about 10 years prior of trading experience before Bitcoin was even invented, you start to realize that cycles, the trust in cycles needs to be a lot longer than essentially 14 years, right?
The U.S. Securities and Exchange Commission instructed Coinbase to halt trading in all cryptocurrencies except Bitcoin before filing a lawsuit against the exchange. This move signifies the agency's intention to assert regulatory authority over a broader portion of the market. Coinbase CEO Brian Armstrong revealed that the SEC made this recommendation prior to taking legal action against the company for not registering as a broker. The SEC case targeted 13 cryptocurrencies on the Coinbase platform, claiming they are securities, falling under the regulator's purview. However, the SEC's prior request to delist over 200 tokens, leaving only Bitcoin, indicates a push for wider authority over the crypto industry under Chair Gary Gensler. Had Coinbase agreed to this request, it could have set a precedent, requiring the majority of American crypto businesses to operate outside the law unless they registered with the Commission. The oversight of the crypto industry has been a gray area, with both the SEC and the Commodity Futures Trading Commission vying for control. The CFTC sued the largest crypto exchange, Binance, 3 months before the SEC took legal action against Coinbase. Gensler has previously stated that he believes most cryptocurrencies, except for Bitcoin, should be treated as securities. The recommendation to Coinbase indicates that the SEC has adopted this interpretation in its efforts to regulate the industry. The implications of the Coinbase case for the global crypto market are significant. It could lead to increased regulatory scrutiny and potential classification of more cryptocurrencies as securities, affecting various crypto businesses and investors. The situation will likely shape the regulatory landscape for the crypto industry, potentially impacting market dynamics and investor sentiment. For more Daily Dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.